Interest rates are expected to rise in the coming months in an effort to tackle the growing level of inflation. The annual inflation rate in the US accelerated to 7% in the last month of 2021, a fresh high since June of 1982. The historic low rate of 0.1% may rise multiple times over 2022, a change that will affect borrowers and savers. The Federal Reserve's purpose is to keep the US economy humming, not too hot and not too cold, but just right. When the economy booms or runs hot, distortions like inflation and asset bubbles can get out of hand, threatening the economic stability. That's when the Federal Reserve steps in and raises interest rates, which helps cool down the economy and keeps growth on track. While the Federal Reserve serves multiple purposes, their number one job is to manage the monetary policy. What does this even mean? This means controlling the supply of money in the country's economy. And how do they control the supply of money in the country? While the Fed has multiple tools at its disposal for the task, its ability to increase or decrease interest rates is its most prominent and effective monetary policy tool. Let's dig in a little further. When people talk about the Federal Reserve raising interest rates, they're referring to the federal funds rate. An interest rate rise is triggered when the Federal Reserve increases its base rate. It means that the Federal Reserve will charge interest on the money it lends to the financial institutions, which eventually has an impact on how much your bank or your lender charges you to borrow money. When the Fed raises the federal funds rate, the goal is to increase the cost of credit throughout the country. Higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments, thus increasing the cost of credit. This usually has an immediate effect on consumers and businesses. Consumers and businesses who cannot or don't want to afford higher payments postpone projects that involve financing. This reduces the supply of money in circulation, which lowers inflation and moderate economic activity, aka cooling off the economy. Now let's look at a real-world example. Let's say a family wants to buy a house and they apply for a mortgage. How does an increase in interest rate affect their overall cost? A family is shopping around for a $300,000 30-year fixed-rate mortgage. If banks were offering them an interest rate of 3.5%, the total lifetime cost of the mortgage would be approximately $485,000, with nearly $185,000 of that accounting for interest charges. Monthly payments would clock in at around $1,340. Let's say the Fed raised the interest rates by 1% before the family got a loan, and the interest rate offered by a bank for a $300,000 home mortgage loan rose to 4.5%. Over the 30-year life of the loan, the family would pay a total of more than $547,000, with interest charges accounting for $247,000 of that amount. Their monthly mortgage payment would be approximately $1,520. In response to this increase, the family in this example might delay purchasing a home, or opt for a home that requires a smaller mortgage to minimize the size of their monthly payment. This very simplified example shows how the Fed reduces the amount of money in the economy when it raises interest rates. Besides mortgage, rising interest rates impact the stock market, credit card loans, personal loans, student loans, auto loans, and business loans. Higher interest rates could have a negative impact on the stock market. When the Federal Reserve rate hikes make borrowing more expensive, the cost of doing business rises for public and private companies. Over time, higher costs and less business could mean lower revenues and earnings for public firms, potentially impacting their growth rate and the stock values. More immediate is the impact the Fed rate increases have on the market psychology, or how investors feel about market conditions. When the Fed announces a rate hike, traders might quickly sell off stocks and move into more defensive investments without waiting for the long, complicated process of higher interest rates to work their way through the entire economy. While higher interest rates might be bad for borrowers, they are great for anyone with a savings account. When the Fed raises interest rates, banks react to increasing the amount you earn in your savings account. If you have credit card debt, an increase in interest rates will definitely have an impact on your finances. You should see an interest rate spike on your credit card very soon. Let's say you carry a revolving balance of $10,000 on your credit card every month with an average credit card interest rate of 16.83%. A quarter point increase in interest rate could add an additional $25 a month in interest to your bill. That's an extra $300 leaving your pocket each year, all thanks to credit card interest. You probably won't notice much of an increase when it comes to your student loans or auto loans you already have. Most of these types of loans are taken out of a fixed rate, meaning the interest was locked in when you signed on the dotted lines on the loan. Not all Fed rate hikes are going to impact you directly, and not all corners of your financial world are going to be affected by rate changes. But keeping tabs on Federal Reserve monetary policy changes is an important part of keeping your financial life in order. For all investors, especially anyone who's getting closer to retirement, rising rate environments need to be handled with care. As in any other market condition, striking the right asset allocation among stocks, bonds, and cash is the best way to mitigate the impact of rising rates.